Your car is declared a total loss. You paid $27,000 for it. You maintained it carefully. You may still owe thousands on the loan. Then the insurance settlement arrives, $20,500. That is not enough to buy the same car from a dealer, and it may not even be enough to pay off your loan. So where did the missing money go? The uncomfortable answer is that your insurance company usually is not calculating what you paid, what you owe, or what it will cost you to replace the vehicle. It is calculating something called actual cash value. And sometimes the calculation is correct, but sometimes the valuation report contains errors that could cost you thousands of dollars. In this video, we will break down exactly how total loss payouts work, why the offer can feel so low, and what you should check before accepting it. This video provides general educational information, not legal, financial, or insurance advice. Insurance policies, claim procedures, valuation rules, and consumer rights vary by state, insurer, and individual situation. Always review your own policy and consult a licensed professional or your state insurance department when necessary. A totaled car does not necessarily mean the vehicle has been crushed beyond recognition. The car may still start, the doors may still open, the damage may even look repairable. But an insurer can declare it a total loss when the estimated repair cost is close to or greater than the vehicle's pre-accident value. Some states use specific thresholds or formulas. In other situations, the decision may depend on the insurer's repair estimate, the vehicle's salvage value, and the rules in that state. Imagine your vehicle was worth $20,000 immediately before the accident. The body shop estimates $17,000 in repairs. The insurer also expects the damaged vehicle to have several $1,000s in salvage value. At that point, repairing the vehicle may cost the insurer more than settling the claim as a total loss. That decision is based primarily on economics, not on whether you personally believe the vehicle can still be repaired. Here is the misunderstanding that causes most of the frustration. Standard collision or comprehensive coverage generally does not promise to buy you a brand new replacement car. Instead, it normally pays up to the actual cash value of your vehicle immediately before the covered loss, minus any applicable deductible. Actual cash value is generally connected to the vehicle's fair market value. In other words, what would a comparable used vehicle have been worth just before the accident? Not what you paid 3 years ago. Not what a dealer is asking for a brand new model. Not the amount remaining on your auto loan. And not the sentimental value the car had to you. A vehicle loses value through age, mileage, condition, prior damage, market changes, and normal wear. That depreciation is one major reason the settlement may be much lower than the original purchase price. To estimate your car's value, the insurer may examine comparable vehicles in your area. That means vehicles with a similar model year, make and model, trim level, mileage, equipment, options, overall condition, and geographic market. The insurer may then make adjustments when a comparable vehicle has lower mileage, better condition, a different trim, or equipment your vehicle did not have. And this is where an offer can go wrong. Perhaps the report lists your car as the base trim when it was actually the premium trim. Maybe it records 82,000 miles instead of 62,000. Perhaps it misses the upgraded safety package, leather interior, four-wheel drive, or another factory option. Or maybe the comparable vehicles are farther away, have accident histories, or are not genuinely similar to yours. A valuation can look official and still contain incorrect information. Let us look at a simple example. You bought your car 2 years ago for $27,000. At the time of the accident, You believe replacing it with something similar will cost around $24,000. But the insurer's valuation report places its actual cash value at $21,500. Your collision deductible is $1,000. So the calculation becomes $21,500 in actual cash value, minus your $1,000 deductible. That equals a settlement of $20,500. Your original purchase price does not control that calculation, and the asking price of a newer replacement vehicle does not automatically control it either. The deductible is the amount you agreed to pay out of pocket before your collision or comprehensive coverage pays the remaining covered loss. Depending on your state and the details of the claim, taxes, title fees, registration costs, and transfer charges may affect the final settlement. Ask the adjuster whether those amounts are included. Now imagine you still owe $23,800 on the loan, but the insurance settlement is only $20,500. That leaves a difference of $3,300. Your standard auto insurance policy does not automatically erase that balance. When a financed vehicle is totaled, the lender is usually listed as a loss payee, so the insurance payment is generally applied to the loan first. If the settlement is lower than the remaining balance, you may still owe the difference. This is where gap coverage may help. Gap coverage is an optional product designed to cover some or all of the difference between what you owe on an auto loan or lease and what your insurer pays after a covered total loss. The exact terms, limits, deductibles, and exclusions depend on the contract. Gap coverage does not increase your vehicle's actual cash value. It only addresses the remaining loan balance after the primary settlement is calculated. If this explanation is helping you understand insurance fine print, subscribe to Fine Print Files. A settlement offer should not be rejected emotionally, but it should not be accepted without review. Start by requesting the total loss valuation report. That report may include your vehicle's specifications, mileage, condition adjustments, comparable vehicles, taxes and fees, deductible, and final settlement calculation. Then, check every detail. Is the vehicle identification number correct? Is the trim level accurate? Is the mileage right? Are the engine, drivetrain, packages, and factory options included? Did the report incorrectly list previous damage? Are the comparable vehicles really the same year and trim? Are they located in a similar market? Small errors can create a meaningful difference in value. If you find a mistake, respond with evidence instead of frustration. Put your concerns in writing. Identify each error clearly and explain why it affects the valuation. You can submit local listings for genuinely comparable vehicles, option documents, pre-accident photographs, service records, receipts, and proof of the correct mileage or trim. Do not simply send the 3 most expensive vehicles you can find. Use comparables that closely match your vehicle's year, trim, mileage, equipment, condition, and location. Ask the adjuster to explain every mileage or condition adjustment and request a revised report after corrections are made. If the claim is under your own collision or comprehensive coverage, review the policy for an appraisal provision. Depending on the policy and state, appraisal may allow you and the insurer to use independent appraisers when the dispute is about the vehicle's value. Third-party claims against another driver's insurer may follow different rules. If the disagreement cannot be resolved, contact your State Department of Insurance or Insurance Commissioner's Consumer Services Division. State regulators may explain the rules, review complaints, and help you communicate with the insurer. You may also be offered the option to keep the damaged vehicle, but keeping it usually means the salvage value will be deducted from your settlement. The vehicle may also receive a salvage or rebuilt title, depending on state law. That can make repairs, registration, resale, and future insurance more complicated. Do not keep the vehicle simply because it still looks repairable. First, investigate the repair cost, safety concerns, title requirements, inspection rules, future insurability, and resale value. Sometimes keeping the car makes sense. Sometimes it creates a second financial problem. So why can a total loss settlement be much lower than expected? Because the insurer is usually calculating the vehicle's value immediately before the accident, not what you originally paid, what you still owe, or what a brand new replacement would cost. From that value, the insurer may subtract your deductible and, if you keep the vehicle, its salvage value. But the offer is only as accurate as the information behind it. Before accepting, request the valuation report. Verify the mileage, trim, options, condition, comparable vehicles, deductions, taxes, and fees. When something is wrong, challenge it with specific evidence. A low settlement is not automatically unfair, but an official-looking report is not automatically correct either. Subscribe to fine print files for clear U.S. insurance explanations. And watch the next video to learn the difference between actual cash value and replacement cost, because confusing those two terms can completely change what you expect from an insurance payout.